Hello, all. Lovely morning. Thank you for joining us on a Saturday morning. Today's webinar will be headed by Sanjay Kumar, Senior Research Analyst at ithought. In this webinar, we will discuss how we value banks, the different metrics that can be used, the unspoken shades of gray in valuing banks, and many more. I hope this will be a fruitful session for you all. Thank you. And I'll hand over the podium to Sanjay now. Thank you.
Thank you, Tarun. Am I audible?
Yes, sir, you're audible.
Okay, perfect. Good morning, everyone. Glad to be back for another TrueBlue webinar. Today, we'll be talking about, as Tarun said, how to value banks, how we go about it. And let's get started. So the primary metric that we use is price to book, as in book here refers to the net worth of the bank and how much over and above can you pay for a particular bank. The other metrics that can be used are price to earnings, which is typically used for every other company, right? And in banking, price to earnings, you can use it when the bank is a structural story where the earnings are not disrupted. In a cyclical bank, the earnings are depressed that you can't value using a price to earnings multiple. Second is price to PPOP. PPOP is pre-provisioning operating profit, that is before providing for any bad loans or NPAs. What is the operating profit that the bank generates? And you give a multiple on top of that to arrive at the market cap. This can be used across cycles, but very useful, especially at the bottom of the cycle. Post wave 2, a lot of small banks, tier 2 banks, were all available at 2 to 3 times PPOP. That is, the market cap was equal to next 2 to 3 years operating profit. Third is some people use it, but we don't recommend it, which is market cap as a percentage of a loan book or deposits. This is more of an input game because it is easy to grow your loan book. So if you want higher market cap, you keep growing your loan book and you expect to get a higher market cap, which is not advisable or recommended. So the primary metric is price to book. We'll delve deeper into price to book. So if you had attended our previous webinar, I had spoken about thumb rule for to arrive at a particular PB multiple. And that is the price to book multiple is equal to economic value addition done by the bank. And how do we do this? You take the ROE of the bank and subtract the cost of capital and divide it by 2. That will give you a rough approximate price to book multiple. So what is the cost of capital? The Nifty 50 long-term CAGR in the last 20-25 years has been 10 to 12%. Okay, you could use that. I'm using 10% because banks pay 1 to 2% dividend yield. Most of the banks do that. So that will take care of the additional 1 to 2%. So your cost of capital is 10%. Let's say there's a bank which has an ROE of 13%. The price to book will be roughly equal to 1.5x. So 13 minus 10, 1.3%, 3% by 2, 1.5x is, it could be a fair price to book for this bank with 13% ROE. Let's say the bank's ROE is 16%. In that case, the fair price to book could be 3x, right? 16 minus 10, 6%, 6% by 2, 3x. So this is a thumb rule which you can use. But the problem with this is you will not get the HDFC Bank at say 2.5x price to book or 3x price to book. Because if you look at the history since listing from 1996 to March 2023, only 17% of the time has HDFC Bank traded between 2.5 to 3.5x price to book. Not just HDFC Bank, the other bank that I spoke about, 13% ROE, only today it is available at 1.5x price to book. In the last 10 years, it wasn't available at current multiples. So how do we go about it, right? Is there a scientific way to value banks using price to book? There have been a lot of studies. And before we get into the studies, we'll have to understand the fundamental principle behind how banks make money. Let's say you have a bond, or it could also be your fixed deposits that you get at your banks. They all work in the principle of simple interest. Let's say your principal is 100 rupees and you have an FD of 7.5%. You will get 7 7.5 rupees every year as interest, right? But your principal throughout the tenure of the bond or the FD doesn't change. It will remain fixed at 100. But in case of banks, they compound interest or they compound earnings in this case. Okay. Let's say a bank starts with a book of net worth of 100 rupees and it earns 13% ROE on that 100 rupees book. In the second year, the bank's net worth would have increased by 13 rupees because that's what they earned in the first year. And let's say they pay 10% of the 13 rupees as dividend and reinvest the rest of the 90% into their own business. So they'll add another 10 or 11 rupees to their net worth. So in the second year, the beginning net worth of the bank will be 110, 111 rupees. So on a higher base, they'll earn the ROE that they make in their business. So this is how they compound interest. And compound interest is exponential. And this is if you put it in a graph, go to Excel, make a table, put some variables, you will see that compound interest is exponential beyond a point and simple interest is linear. So this is the core fundamental principle on which we'll have to look banks. Another graphical representation of how big this compounding can be. Let's say you start with 1 lakhs and you invest it for 20 years at 10% per annum. If it's a simple FD or a bond, you'll make 3 lakhs. But in case of banks, if you give it to a bank, they would have made 6.72 lakhs, right? So this is the power of compounding. So there is a professor called Damodaran. He works at New York State University, and he is known for valuation. Not just for banks, it could be any valuation. It could be valuation of intangibles, valuation of businesses, valuation of startups. So in 2000, he's done a study on all the US companies and US banks. So he's plotted, if you look at this graph, the x-axis at the bottom. So this is the ROE of the US banks. 0.1 represents 10% ROE and 0.2 represents 20% ROE. If you see, there's an exponential relationship is changing beyond a certain point. It could be 15% ROE or 13, 14% ROE, where the price to book ratio, which is on the y-axis, starts jumping beyond a point, right? This was done in 2000. He repeated the study in 2012 to check how the relationship has evolved. And again, the result is same. So you wouldn't know most of these names, but JPM is JP Morgan, which is the largest bank in US. So it was in 2012. It had an ROE of close to 10%. So it was being valued even less than book, one times price to book. But beyond the point, that is say 13, 14% ROE, there is jump. Banks are being valued at 2 times price to book. So I've indicated this box here. So R square of this relationship or of this graph is 61.9%, roughly 62%. So what does R square indicate? So R square is a statistical measure that represents the proportion of the variance for a dependent variable. Dependent variable here is the price to book multiple. So how much of the dependent variable is explained by an independent variable? Independent variable here is the return on equity. It could be in regression, there could be many variables, or in our case, where we are valuing banks, it could be just one variable, which is return on equity. So in professor's study in 2012, 62% of the bank's price to book multiple was being explained by return on equity. So what explains the balance, right? So he went on to explore that aspect as well, where he added few more variables, like at the bottom, you're seeing payout ratio, expected growth in earnings per share in the next 5 years, return on equity is already considered. So he's added 2 more variables, which is payout ratio and expected growth in EPS. 3-year regression, I mean, it is beyond the scope of today's webinar. So let's just consider payout and expected growth. So although the R square drops from 62 to 54%, all of these variables are significant. So in statistics, there is a concept of significance where you test each variable if it really makes sense or not, right? I mean, statistics is like this, you given junk data, the output will also be junk, but you given proper data, the output will be proper. So that's measured through test of significance. I'm just approximating all of these principles in a very basic, simple terms. There's a lot of beyond what I'm saying. Okay, so all of these variables are significant. So when I started covering banks, I used to do these studies for Indian banks. So this is data for FY22. So this will be sometime in 2021, where I ran the study and I got an R square of 78%. So the price to book multiple ROE is able to explain 78% of the price to book multiple. And you can again see this curve, right? Beyond a certain point, a jump is exponential in price to book. So I've done this study across years. I've done this 4 times till now. And if you look at the average, let's say for a 9% ROE bank, you can pay 1.3 times price to book. And I'm increasing the ROE every 2% every time, right? And the increase in price to book is exponential. For every 2% increase in ROE from 9 to 11 to 13 to 15, look at the jump in price to book. The first 2% ROE jump is 0.3. The next is 0.4, then 0.5, and it goes up to 0.8, which means the higher the ROE, the exponential the price to book multiple. So a bank makes a lot of money when it goes from 9% ROE to 15 to 17% ROE. 19% ROE is difficult for large banks. Some NBFCs can do it. So 15 to 17% is like the peak ROE for the large banks and even the tier 2 banks. So that was my study. And we also looked at what the other players in the market. So I think this is by B&K Securities. They are a brokerage well known in India. So they've also done a study and their R square was 81%, much higher than mine. And all these iterations that I did, so depending on the market situation and how banks have been valued by the market, the R square range from 40 to 77%. So even in the worst case, ROE is able to explain 40% of the price to book multiple. And then this is the latest by Spark. Again, they're a research house where they're valuing banks on ROA and versus they're comparing it with the price to book multiple. This is based on their financial projections for FY25. And if you see below 1.5% ROE, it's almost linear, or I wouldn't even say it's linear, it's flat. So market values all of these banks in the same way based on the ROA. There's no indifference that market is having. But beyond that point, let's say 1.4% ROA is where the jump happens. You'll see the large banks having higher ROA and then being given a higher price to book multiple by the market. So what factors could explain the price to book? Okay, so based on statistics, what we have seen so far, done by Professor Damodaran and by Indian research houses. So return on equity is the predominant metric, or return on assets, because the difference between return on assets and return on equity is the leverage that banks take. Some PSU banks take 10x leverage, so they put in 11 or 9 rupees and they'll lend 100 rupees of loans. Some private banks put in 11 rupees and lend 100 rupees of loans. That's the difference in leverage that banks have. Based on that, the ROE can be changed. It could be manipulated. So it's better to look at ROA. And the second was expected growth, let's say for the next 3 years or the next 5 years. And finally, payout ratio. Payout ratio is kind of, it's significant, but it's irrelevant for Indian banks because all the top banks pay only 10 to 15% or max 20% of their profits every year as dividend. All the rest of all the money is they invested back in the business. So it's kind of irrelevant for Indian banks. So these are based on statistics, based on test of significance. But life is not always black and white. There are many shades of gray. I like to say that valuation is 50% science and 50% art, right? So the markets are also gray, just like life. And so what other factors could explain price to book? What are the shades of gray? So based on my observation of studying banks in the last few years, found that longevity of your ROE, how long can the bank earn that ROE sustained? right? And consistency. Let's say a bank earns 15% ROE one year, 10% ROE the next year. There's no consistency. There is a lot of volatility. So there's some issue. It could be cyclical. So the consistency is also as important as longevity of the ROE. Finally, I'll put all these other shades of gray in the same bucket where I call it the premium. Market tends to pay premium price to book for certain banks based on certain factors. One of it is skin in the game. Most of the banks driven by regulation also, there's no promoter in the bank. It'll all be professionally managed, board run banks. But there are certain banks which are owned by the promoter, at least say 15% to 25%. There, the bank markets have tended to give a slight premium. And let's say a bank is going through a transformation, say a new promoter took over a bank, and then they're changing the structure of the bank to increase the ROE and so on. There, the markets give a higher multiple. And say a bank has a rapid growth beyond what the ROE can even provide. Let's say the bank is growing at 20, 25%. There, the market has given premium. But this the third bucket that I've put, I'm not very comfortable because we'll see some examples. Let's say skin in the game. This is the price to book chart of Kotak Bank. So between 2014 to 2021, Kotak Bank traded between a price to book range of 4 to 5.5x. It even did above 5.5x for some time. So Kotak Bank market was giving a premium to Kotak Bank, but RBI came out with a new regulation saying that they cap the age limit of the promoters. Like, let's say if you've been the promoter or the CEO for 10 years, you'll have to give way for someone else, right? So RBI wasn't comfortable with the same guy running the bank for a long time. So they brought in regulations capping the tenure of the CEOs or the promoters. Again, so there was also some feud going on between Kotak and RBI where RBI wanted Uday Kotak to reduce his stake. That didn't happen. Uday Kotak won that battle. He retains still his stake, whatever he had, right? But given the new regulations, market derated Kotak Bank from say 4.55x price to book. Today it's trading close to 3.1, 3.2 kind of price to book. So that premium is gone. Second factor was transformation. Transformation is difficult. On the top is CSB Bank, where Fairfax took over CSB Bank and they put it on a transformation journey. At one point, CSB Bank was trading at 3 times price to book. Around that time, they were trying to disrupt the gold loan market, where Muthoot and Manappuram were the leaders. So I think this was roughly the Q4 FY21 call where I asked the CSB management if the banks will disrupt gold loans. And the then CEO, Mr. Rajendran, actually, if you listen to the audio, he would have said that if we continue to do what we are doing, NBFCs will be history. But I don't know for what reason they've rephrased his statement in the actual transcript. So the audio might still have that wording where he says NBFCs will become history. And that kind of marked the top for CSB Bank and Muthoot Finance. So CSB fell from, say, I think it was 300, 350 rupees to 200 rupees. Even Muthoot fell. But it took CSB Bank 2 years to go back to where it was, but the multiple has derated from 3 times price to book to close to 2 times price to book today. Okay, transformation is difficult. It is not easy because the scale at which banks operate and the number of employees, it is not very easy to complete the transformation 1 or 2 years. It takes time. It is not just time. Transformation is also painful. If you ask the IDFC first investors, they'll vouch for that because the share price of IDFC first went from I think 70 to 30, almost 50% correction from 2x price to book to 1x price to book. So market was pricing in higher ROE that the bank will be able to do, say, in 2024-25 in 2021 itself, right? So they were pricing in 3-4 years of growth. And when that didn't happen, wave two happened and more provisions were had to be done. So that kind of freaked the market, and IDFC first got derated. There are other issues also. So the summary is transformation takes time and is painful. And even if you've done the transformation, it is tough to sustain. City Union Bank was apparently called the next HDFC Bank because of what they've been doing. There was a lot of narrative around this bank saying that for 100 years they've had only 6 CEOs, but they weren't able to sustain that transformation. From the peak of 3.5x price to book, today it's below 1.5x price to book. Today they're saying that they don't have the technology to grow. They're going to spend more on technology today, and so there are a lot of issues. They couldn't compete with the larger banks. So they were after SBI. CUB had the highest SME book in Tamil Nadu, but HDFC Bank, which entered Tamil Nadu and SME banking only in 2003, in 20 years they've overtaken City Union Bank as the second largest SME bank in Tamil Nadu. Not just HDFC Bank, even Axis is trying to gain market share from City Union Bank in Tamil Nadu. So they've been, whatever they've done in the past, they were not able to sustain it. So again, transformation is takes time, is painful, is tough to sustain. So do you want to pay the premium for these factors? And Monish Pabrai, who is also a well-known investor, he bought South Indian Bank at in 2014, and after his buying, that kind of marked the top. Because so what was the story then was the 3 years before Monish Pabrai's investment, South Indian Bank was growing at 20% CAGR every year. Like I said, so it was growing rapidly. Okay, and when you grow rapidly, issues come up, and issues did come up in South Indian Bank. And if you check this middle chart, South Indian Bank's ROE went down from 19% to 16%, and it fell flat at 8% for the next 3 years. Market will punish you in that cases. Then that's what happened in South Indian Bank. There are multiple examples where rapid growth has been a red flag time and again. I've just given just one more. You could take S-Bank, you could take IndusInd. They all suffer from their rapid growth. And it's not like RBL Bank had a very high ROE either. It was just 10% to 12% during their high growth phase. But when the provisions started and when the NPA started, because they were lending to a lot of triple B rated corporates, and which went bankrupt or they weren't able to honor their interest payments. So RBL started providing more. So that even that low ROE fell down further. It halved to 6%, 4% kind of. This is COVID, but even before COVID, you will see this fall from 4 times price to book, and it fell to 2 times price to book. Okay, so rapid growth has been a red flag time and again. So that leaves us with two other shades of gray, which is longevity. I have given here three banks' price performance, stock price CAGR, and their return on equity. This is the best picture, I think, which will explain why longevity matters in banking. The first bank, which has had a 17% ROE for 10 years, gave investors 17% CAGR in 10 years. The second bank, which had 13% on average, I'm not saying every year they had 13%, across cycle, they had 13% ROE, slightly higher. The investors got a return of 14%. And the stock price, this is the third bank where the ROE was 10%. The investors earned 10% CAGR on their investment. This is the proof that longevity works. Higher the ROE, higher the stock price CAGR, that bank. Now, we'll look at a case study from the US, the curious case of IBM. It is none other than our the greatest investor of all time, Warren Buffett. But before that, the prior to his buying of IBM, we'll look at the story. So this black line that you see is the ROE of IBM. Okay, and this bars, the towers that you see, is the price to book. So from a peak of 20% ROE or roughly 25% ROE, IBM's ROE fell below 0%. They were into losses. okay, in these 3 years, 1991 to 1993. And the price to book fell from, say, 3.5 times to as low as 1x price to book. So the best time to buy IBM was when it was making losses or when it was trading at 1 to 2 times price to book, not here. But then they recovered, and then the tech boom of 2000 happened, where they made insane money. They made 40% ROE at the peak of the tech bubble in the US. So this is how cyclical IBM's ROE has been, and that is driving the price to book. Okay, so from 1x price to book, IBM went to 9x price to book. So you did a 9x just on the re-rating itself. If you had bought it at the lows of 1991, 1992. Okay, so now time for Warren Buffett. So this is the IBM's ROC, return on capital employed chart before he bought. That is from the bottom of the tech bubble till the time he bought. He bought sometime in 2011. So till then, the ROC has kept going up. But I think Warren Buffett felt that till then he wasn't investing in technology stocks, but I think he was convinced by then that technology works, and just that he made the wrong choice within the technology sector. Okay, because this didn't turn out to be a structural story. It became a cyclical story. Okay, so this is where WB bought IBM at 40% ROCE. IBM was able to better that in the next year, but that was the peak. After that, they were never able to make the same kind of money again. So it turned out to be cyclical rather than structural, and that's how WB couldn't make money in this investment. But then he was clever enough to reinvest this money that he sold from all of his stake from IBM into, he switched to Apple. So he's made more than he's compensated for all of this loss from the IBM investment by investing in Apple, which is where the return ratios are stronger and look more structural in nature. So, like I said, longevity matters and also consistency matters. Can a bank sustain the ROEs that they're making for a long period of time, let's say 10 years, 15 years? Because the longer the duration that they sustain their ROE for, then that's when you make the compounding, the power of compounding kicks in. This is a share price chart. He bought around, I think, around 160 to 170, and he exited at around 150 to 160. So, but IBM was paying some dividends, so he made a marginal return of 5% during this period of 5-6 years, but which is much lower than S&P 500 or what the Nasdaq returns were during this period. Again, picture speaks 1,000 words. This is a slide from HDFC Bank's recent presentation where they show their moat or their might. All right. So across 10-year period, their ROA has been consistent at 1.9 to 2.1%. In simple terms, this is what creates wealth in the markets if you're able to sustain the ROE long enough and consistently. Again, investors tend to fall in the structural cyclical game, where recently a lot of banks have done really well for the shareholders because of this jump in ROE. And now it is for the investors to decide if this ROE can be sustained going forward, because their 10-year track record is saying a different picture. So in short term, bank is cyclical in short term and structural in the long term. You'll have to differentiate cyclical stories and structural stories, where in the past the bank has done such ROEs. In the middle, it fell off because of NPAs and all, but now it's coming back. So in the past, it has shown the capabilities of making high ROE. So that could be a more structural story than the banks that we saw in the previous slide. So what is the market consensus today? So we'll take a leap out of the bond market to explain what the market is saying. Sorry. So before we look at what is the consensus today, we'll go back in the past to see what could have happened, what you could have done in the past. Okay. So this is how. So usually bonds how do you value bonds is that, or for simplicity's sake, let's take FD. Let's say you deposit 100 rupees in a bank, you will get 7.5 rupees if it's the FD rate is 7.5%. But what if you want to earn more? Let's say you want to earn 8%, 9% on your FD, then you'll have to uh, deposit only 95 rupees or 96 rupees in the bank. Only then the additional 3 4 rupees will give you that higher return. So that's how you'll value the bonds or fixed deposits in the market. I'm using the same principle here, right? So this March 2004 to March 23, the ROE values are the actual values of HDFC Bank's ROEs in the last 20 years. I am plugging it in, and I am saying that I'm discounting all the price to book, all the ROE values that HDFC Bank has done at the rate of 7.5%, which is today's India's 10-year bond yield is 7.5%. To make, let's say today HDFC Bank is trading at 3 times book. To make an IRR of 14%, you could have paid even 6.5 times price to book for HDFC Bank had you known that HDFC Bank will make 21% ROE in 2004 and it will do 17% ROE in 2023. So what is the case with ICICI Bank? So this is the actual ROEs of ICICI Bank in the last 20 years. If you see the red area, that's where banks went through a tough cycle. But look at the difference in HDFC Bank and ICICI Bank's ROE. It was almost 2x of what ICICI Bank was doing. And hence, the implied price to book multiple is also different, significantly different, almost one third. To make the same IRR, because even today, ICICI Bank is trading at 3 times price to book. To make the same return of 14%, I could have paid 2.3 times price to book for ICICI Bank. I could have paid 6.5 times price to book for HDFC Bank. But HDFC Bank was available at, I think, 4x, 5x price to book. So you would have made more than 14% had you invested in 2003. If you had the vision that HDFC Bank will have a consistent ROE compared to ICICI Bank, where it is more of a cyclical ROE. So using the same template, this might be a bit too much for you, but just understand that the longevity and consistency of ROE matters more than the ROE itself. Okay. So what is the market thinking today? Let's say from March 2024 to March 2043. Today, HDFC Bank is being valued at 3 times price to book by the market, which means market is expecting ROEs to tend lower, to go down the double-digit level from say 15% to 12%. But ICICI Bank is being valued slightly higher than HDFC Bank, which means market is saying that ICICI Bank's ROE will remain higher than HDFC Bank for some period of time in the near future. So if I model it like this, let's say 16% ROE compared to HDFC's bank 15% ROE, that's when I'm able to justify what the market is paying for ICICI Bank today, which is 3.2x. So today the consensus is that ICICI Bank will make higher ROE than HDFC Bank. So what factors explain price to book? Return on equity or return on assets, longevity of this ROE, and the consistency of this ROE. So are Indian banks where IBM was or where Apple was? To bring it down to just to summarize the entire presentation, banking is short-term cyclical and long-term structural so far. Let's say you go to say you plot Nifty Bank versus Nifty 50, that will be an uptrending graph. Okay, you take all the Nifty Bank index values and the Nifty 50 index values, it will be an uptrend, which means banking in the long trend is structural, but within this trend there will be cyclical phases of banking. But that could change. We don't know when it will change. And if the bank is being given a premium, that premium can come down. It can only come down. It will not keep going up. And the discount, it can keep going up also based on what the changes are. And discount rarely changes into premium. That will be very difficult for the bank to pull off. When do you buy an exponential ROE bank? When it is available at a linear price to book. Okay, let's say market is giving a premium. You don't have to pay a premium. You wait till it falls to a linear growth trajectory or linear price to book multiple. Another thing is a lot of people don't talk about the exit price to book multiple. Let's say in this graph, today, if you had paid 6.5 times price to book in 20 years ago, today HDFC Bank is trading at 3 times price to book. So that's why your IRR is not the same as bank's starting ROE. Had HDFC Bank did 21% ROE today also, then the IRR would have been close to 21%. It's not because structurally, given competition, given the scale, the ROEs will tend lower. So you can't expect to market to give the same price to book multiple 10 years down the line or 20 years down the line. Like I said, valuation is 50% science and 50% art. So all of this boils down to ROE, and there's something called as ROE tree, which is what we study. We look at how the ROE, the final figure that you say, let's say 16% for HDFC Bank, how is it arrived at? How are they able to do it? Will it be sustained? All of the answers lie in ROE tree. That is why we believe that investing in banks is best left to practitioners like us, because we do it full time. We'll study ROE trees of various banks. We'll do relative, we'll do absolute comparisons, and we'll have a network to see what the bank is doing. Let's say day before yesterday, HDFC Bank had a loan mela in Trichy, or yesterday they had a car loan mela in Gujarat. So we keep looking at what the banks are doing, and is the ROE transformation journey that they're on, is it structural or is it cyclical? Will they be able to sustain? If they are sustaining, for how long can they sustain? So we keep doing these studies to estimate ROE 5 years from now, 10 years from now. So it's best left to practitioners, and that brings us to the ithought way of our investment philosophy, how we go about our investing. So we have a pretty long-term focus, and that helps us capture the power of compounding. Okay, and we do non-consensus investing. We talked about what the market consensus is today. So we'll not be there. We'll be where the consensus is not there. We follow a bottom-up approach. We don't look at what the user is doing. It's important, but the final decision is made bottom-up. We have a very high focus on risk management. Risk management in banking comes through the growth that the banks are doing. We don't want to pay for growth. So the TRUBLU portfolio it captures the best of both worlds, both the India growth story and the global champions, which is our IT company, and even EPC players like L&T. So this portfolio enables you to capture both the mega trends. The USP of TRUBLU, our PMS product, is it's 100% pure large cap, and we have a very high active share, and we don't trade. Our churn is very low, as low as 10%. We usually have a buy and hold kind of strategy if we are comfortable with the execution of the management. And there are two options: zero fixed fees, and it could be completely variable. So TRUBLU was designed with first principles thinking thought process, where we just wanted to have pure large caps, just 20 stocks in our portfolio. But if you look at all the other large cap funds in the market, they all hug the index, as in they try to mimic or imitate the index. The lowest number of stocks that a fund has is 39, Axis Blue Chip Fund, that has been doing terribly in the recent times. So our active investing is our moat or forte, I would say, because if you look at the breakup of the stocks, the top 5 stocks we are underweight, and the mix will be different, which we'll look in a bit. The top 10 stocks we are overweight. The bottom 5, because we only have 20 stocks, will obviously be overweight, and the bottom 10 stocks we are significantly overweight compared to the Nifty 50, okay, which is our benchmark. And within that, the top 10 itself, there's a significant change of mix. Like, for example, we don't have Reliance, we don't have HUL for various reasons, and we are underweight on Infosys and ITC. This is not the right time to be overweight in ITC. We were overweight in 2020 and 21. And today we are overweight on Bajaj Auto, HCL Tech, HDFC Life, Maruti Suzuki for various reasons. So this has been the performance of our fund since inception. Uh, this is the issues of inception. The first, because we'll be taking time to deploy the funds, but over time, if you see, the gap has been widening with Nifty 50, the blue line. So we have been able to consistently beat the benchmark across time periods and across market corrections, which we'll see in a bit. So since inception, there have been two large drawdown periods, that is market correction. One was June 2022 bottom, which is post the Russia-Ukraine war, where our fund fell 12%, but all the other large cap funds fell higher than TrueBlue. And Nifty 50 itself fell 17% during that bottom. And the next bottom was March 2023 of this year, where our fund fell 5% and Nifty's fall was 2x of ours. It fell 10% during this period, and we have significantly beaten all the other large cap funds in this drawdown period. So our endeavor is to do 200 to 300 bips alpha over and above the benchmark, that is Nifty 50, that is 2 to 3% across 3-year rolling time period. Product suitability is best suited for first time investors if you're new to markets, or if you're close to retirement, or you have already retired and you have a retirement corpus that you want to invest, and best suited for family offices and institutions. So TrueBlue is a resilient, high quality portfolio that should be part of your core wealth chest. Fact sheet. So we have 36 crores of AUM, and this is the weights of the top 10 is 67%, and the beta is 0.73. So we are taking 27% low risk compared to the benchmark. Investment team, I thought was founded by Mr. Shyam Shekhar, well-known investor. He has 3 decades of investing experience, and the co-fund manager is Mr. G.R. Balaji. This is the complete team at ithought. So we have 4 funds. Solitaire is our multi-cap fund. TrueBlue is what we spoke about now, pure large cap PMS product. Riddhi is a small and micro cap PMS product. Spear is multi-asset PMS. And for each of these funds, we have respective fund managers, and I am part of the research team. So the current performance of TrueBlue against Nifty 50. So if you look at the 1 year and 2 year, ideally we would look at a 3 year, but we still haven't finished 3 years because the fund was launched in March 2021. But if you look at the 1 year and 2 year, we have been beating the Nifty 50 by 5.6% in 1 year, and almost 2.5, more than 2.5% in the 2-year time period. Key terms: minimum investment as mandated by SEBI is 50 lakhs. So the investor has an option of complete variable fee or an option of 1% fixed fee. That's the end of our presentation. Wish you happy investing, and we'd be happy to take any questions that you have. Please drop your questions in the chat box at the top. Someone is asking for the fees. Just a second. So there are 2 options. First option is 0% fixed fee and a performance fee of 20% profit share above a hurdle of 6%. Right. So only if we make more than 6% for you, we'll charge a performance fee of 20% above this hurdle rate of 6%. The other option is 1% fixed fee. You can choose which one you want to have. Okay. The other questions. What's your take on housing finance companies? So housing sector as a whole grows at say 12 to 15% across cycles, and it's a low ROE business because the asset is secured. The loan is secured against your house. So it's not a very high ROE business. So you'll have to give the right price to book multiple for such housing finance companies. If it's an affordable housing segment, then it's a completely different game where the growth is higher, the ROE is higher, and the segment that they cater to is also very sensitive to the economy. HDFC Bank today is trading at less than, I think it's trading close to At a consolidated basis, it's trading close to 3x price to book, and the implied growth that you factored in for arriving at the multiple. So uh, the growth is in a way linked to the ROE. I mean, if you grow at, if your ROE is 14-15%, you can grow at 14-15%. If you want to grow faster than that, then you'll have to dilute it. You'll have to come to the market, raise capital to grow faster. We are not baking in such assumptions because that'll be too complicated and it'll be overkilling the entire process. I just wanted to give you a basic sense of what the market is thinking today. That HDFC Bank's ROE could be lower than ICICI Bank, or HDFC banks and HDFC Bank's ROE could tend lower, let's say 10 years from now or 15-20 years from now. You'll have to be careful about your exit price to book multiple. Please send this presentation. So this recording will be uploaded in our YouTube channel. You can watch the video in YouTube. Will expansion of UPI in long run to all aspects of banking impact bank ROEs? So there was an interesting study where today, because of UPI, the ATM transactions are coming down. ATM is a cost for the bank. So by people reducing the number of times they go to an ATM in a month, and if it goes down further in the next few years, that is actually beneficial for banks because they don't have to maintain the ATM and they don't have to spend on the ATM network. The current set of network could be good enough, so they can more and more UPI implementation in the country is beneficial for banks. Of course, the other negative aspect is today UPI is not income earning for banks because there's no merchant discount rate that banks charge or any merchant has to pay for UPI because RBI has mandated it that way. They want to keep UPI free for as long as possible. So you can't make money from UPI, but otherwise the ATM or the NEFT fee or the RTGS fee is very small for banks to even impact the ROE. Can we compare NBFC and banks? You could use the same principle, sir, of price to book, but you can't compare NBFC with a bank because banks can take deposits from you and me and then lend it as loans to borrowers. NBFCs will have to completely rely on borrowings, which they borrow from banks and other institutions. So, in fact, NBFCs are clients for banks. So, you can't do a like to like comparison, but you can use the same principle of what we have been covering in this webinar. What is your expectation of the long-term sustainable ROE for HDFC Bank post-merger? It is very difficult to say, sir, because the next 2-3 years will be kind of not a normal year for HDFC Bank because they'll have to comply with the PSL compliance. Because HDFC Limited's loan book that came into HDFC Bank, they're not PSL ready. As in, every bank has to lend 40% of their loans to PSL sectors, which could be your agri, it could be your SME and affordable housing and so on. So they're not compliant on that on day one. RBI has given them some leeway. They can take 3 years to do that, and they'll also have to garner more deposits going forward to make up for the HDFC Limited book because HDFC Limited was a NBFC. Most of their funds was through the borrowing route. It could be bond market or it could be other forms of borrowing. HDFC Bank will have to garner deposits to compensate for that. So the next 2-3 years, ROE could be subdued, let's say 15-16%. And it remains to be seen if they can go back to 17% or 18% ROE. We'll have to be dynamic about it and take a call after the merger is completely integrated. Every year you take fee or while exit will, so it's every year it will be quarterly average, it will be charged quarterly. So what about S-Bank present conditions? I don't want to take stock specific questions. I would request you all to limit it to a specific strategy or common questions. Can we merge ROE and ROA to get a better measure based on the respective capital? Instead of merging, you could just use ROA. That would be a better metric than ROE. Every banks have different provision criteria. I don't think so, except say someone like HDFC Bank and even CSB Bank, they have aggressive provisioning criteria. But all banks follow what the RBI norm states. On day one, you'll have to provide 1% of the loan as provisions, and on every so there are three stages, and based on which you'll have to provide. So first could be 25, you will provide 25%, then you'll provide 25%, and so on. So there is a clear RBI mandate on how the provisioning has to be done for a NPA. But some banks, they want to be conservative, so they'll be aggressive in their provisioning. Do you think HDFC Bank's ROE has moderated in recent years mainly due to keeping higher capital ratios? Yes, higher capital ratio is also an issue. That's why if you see that slide that HDFC Bank had put out, their ROE has come down from 18% to say 16%, but they have maintained their ROA at 1.9 to 2.1%. But now the ROA itself is in trouble because of the merger. This year they could end up with 1.7, 1.8% ROA. They'll have to make up for it. They've been consistently putting up a lot of branches, almost 1,500 branches in the last 12, 18 months to compensate for this loss in ROA, which they're saying that it will take 3 to 4 quarters to normalize. So till then, there'll be pressure on HDFC Bank's ROA. How will be the growth of gold loan NBFC in future? Banks are getting fund at lesser price than NBFC. Right. So this is a very interesting disruption that's going on, where banks entered NBFC's territories in gold loans. Everybody started opening a separate gold loan desk at all their bank branches. Till then, only NBFCs were focused on it. Now banks have also started. But gold loan is a difficult business for banks because of the OPEX. You'll have to collect the gold, you'll have to check the quality, you'll have to store it, and so on. That's a high OPEX business. That's why NBFCs had an edge, because they were very nimble compared to a bank branch setup. But now banks are focusing on gold loans because they'll have to grow somewhere. Corporates loan wasn't growing in the last 2-3 years because corporates are they're making enough cash flows to fund their growth. So banks had an option to either grow the retail loan or the gold loans. So they focused on both, and that's why you're seeing good growth in banks' gold loan book. Can you please talk regarding the change in cost of capital impact for banks, especially the high ROE banks? So if the cost of capital goes up, like say the repo rate has gone up 250 bips in the last 2 years in the rate hike cycle, so the banks will change their loan yields first, what they charge on their loans. So their NIMs went up in FY23, and they'll now only in the last few months, few quarters, you're saying the deposit rates going up, which means the cost of capital for the bank is going up. So there'll be NIM compression, net interest margin compression for banks in FY24. What is your take on IDBI First Bank, the proposed merger of IDFC? Will it benefit IDFC First in the next 2 years in terms of ROE? So I think there's some capital coming from IDFC's holding company. So that'll give capital for IDFC First to grow. But I don't want to comment on specific banks, sir. Again, small bank like Federal has given better returns than HDFC at most times, although HDFC is far more consistent. Federal Bank, Shyam is doing a good job over there. If you talk to any Federal Bank guy, he'll say that had our head office been at Mumbai, we'd have got better returns from the investors. Maybe There was a joke. So the thing is, there's not. Uh, we don't see evidence for growth there. There is not hunger there. They're very conservative. Federal Bank. If you see the credit costs are as good as HDFC Bank and Kotak Bank. But again, they haven't taken that jump where their ROA will go from today. I think it's close to 1.3%. But the jump in price to book happens when they can go from 1.3% ROA towards the 1.7 level. They can't get to 2%. Their structure doesn't allow them to do so. It is very difficult for them to even get to 1.5% ROA. Small cap banks, how much minimum ROA and ROE is ideal for investment? So again, that's what we've been talking about. ROA, ROE for a particular point in time is irrelevant. Today, SBI is making 17% ROE. I think they closed FY23 at 17% ROE. That doesn't mean you can give them 3 times price to book, okay? Because that ROE is not sustainable. But if you see evidence that it can be sustained, only then you pay up, right? Which is not ideally good for the investor. Should we stay away from microfinance banks? Okay, microfinance is not part of Nifty 50. Microfinance is a high risk, high reward sector. I'll leave it at that. There has been a 2000 basis point decline in interest rates between 1980 and 2020. Does the structural story of last 20-year rise in private banks banked by high ROE have similar likelihood of repetition? Wish I was a visionary to answer that question. It is very difficult to look 20 years into the future, let alone say 5 years, 10 years down the line. We don't know what will happen. Kal kya hoga kisne jana, favorite song of mine. So there are chances of that repeating, but not, let's say, banks cannot do 18-20% ROE. Let's say they'll do 13 to 15, 16% ROE, which is good enough for us investors. What is your view between private sector bank growth versus public sector bank growth for the next 5 to 10 years? So it all comes down to that point that I've been talking about, so ROE. So if you want to grow at 15%, your ROE has to be 15%. If it's not, you'll have to come to the market, raise capital, and so on and so forth. So that's a vicious cycle, right? Or a virtuous cycle, depending on which side of the cycle you are on. So public sector banks currently they have a very different cost structure, which is what I've been talking about, the ROE tree. You'll have to break it down to see which bank can grow at what rate. Does the structure allow them to grow faster? What kind of lending do, what kind of practices they have? You'll have to study all these to arrive at which private bank or which public sector bank can grow faster. What's your view on repo rate? Do you see any increase in bank rate going forward? Again, very difficult to call out. If you try to predict macro, you've just wasted your time. I think it's a famous saying, right, by Peter Lynch. So we don't want to predict where the repo rate will be. You look at banks which have been performing well even during the high repo rates. So again, within the ROE structure, one important metric is the cost of funds. Any bank which has the lowest cost of funds will have an advantage over other banks. So you'll have to choose which bank can have the lowest cost of funds, not just today, can they sustain going forward? Question from YouTube: how do you see credit card supply on young generations and benefit of banks? Today, credit card supply is only being done by banks. And India, I think today we are at 6 to 7 crores of credit cards issued in the country, whereas the population is 140 crores. Obviously, huge mismatch in terms of the penetration. But there are newer forms of credit. UPI has come in now. Till last year, RBI allowed only debit on UPI. Now they are allowing credit on UPI also. I mean, so you could take a loan and then you connect that loan account to your UPI ID. You create a separate UPI ID for your loan account. Okay, and then pay normally that you do today. You scan QR codes, and instead of money debiting from your savings account, the money will be debited from your loan account. So there are newer forms of credit that have developed thanks to UPI and RBI. They've been consistently evolving based on the fintech and the technology available. But the credit card penetration is still younger, so banks will of course benefit from credit card penetration going forward. It could not. So the form or the structure could change, but at the end of the day, it's credit. It could be credit in form of a card. It could be credit in the form of UPI. Do you see any acquisition happening in banking sector? What synergy will be there? So there has been this hope story of all these regional banks being taken over by large banks. So Kotak acquired ING Vysya, and then there were rumors that the large banks will acquire South Indian Bank or Federal Bank. It's very difficult because the structure of the shareholding pattern makes it difficult. Okay, so let's say when Kotak acquired ING Vysya, the parent had 40% stake. So Kotak was able to absorb a large shareholding from a single seller. But if they were to acquire, say, South Indian Bank or a Federal Bank where there are no promoters, it will be very difficult for them to do it. And any bank will only acquire a bank where it feels that it lacks in a particular area or geography. Kotak wasn't very huge in South. They went and acquired ING Vysya, but now they've got that covered. The only bank that is up for acquisition is IDBI Bank, where it's currently the process in ongoing, where the RBI has received, I think, 3 bids for the acquisition of IDBI Bank. New companies like Aptus Housing are trying to fill the void left by HDFC. Your take on this and impact on HDFC Bank in the housing loan sector? So you're comparing apples to oranges. Aptus is into affordable housing where the ticket size is as low as 5 lakhs, max, say 10 lakhs. But HDFC Bank is in a different league. It'll, let's say the house property is 2 crores, it will fund 1 crore for that. So it's a different, they operate in completely different segments. Aptus is in affordable housing, HDFC is in regular housing. Apologies for completely irrelevant question, but I've been following you since a long time and I'm passionate about equity research. I'm a CA. What should I do to become a research analyst like you? Big fans. And I know this is not the right platform to answer this question. Maybe I would request you to reach out to me personally or in Twitter, sir. When do you sell a bank? What factors need to be seen before selling a long-term investment in a bank? If you think the story is structural, it makes sense to stay invested unless the valuations are exorbitant, where the premium factors that I spoke about, skin in the game, rapid growth, or it could be transformation stories. There, if you see that market is pricing in few years of growth or much more than what the bank deserves to be, at least on a statistical basis, then you should think about exiting. Or if you think that market is losing ground, the bank is losing ground in terms of market share, for example, City Union Bank in Tamil Nadu, where they were losing market share to say HDFC Bank and Axis Bank, which is very difficult for a retail investor to do. That is where we come in. So we keep studying the market. So it helps. We'll have some kind of view on what's happening on the ground. Which is very difficult for a retail investor to do. Excess ROE over cost of equity and add the net worth to arrive the fair price to book multiple. But which net worth do you take for valuing the bank? Current net worth or the discounted value of the terminal net worth? So again, this is complicating a simple science. And even if we try to complicate it, that doesn't explain fully. Some percent of valuation is still art, like I said. So I mean, you could stick to current net worth, because discounted value of terminal net worth, you will not know what will happen to the yields at which you discount it at. You will not know what the growth rate for the bank will be. So it's better to stick to current net worth. So you see affordable housing as a new growth area in the coming years. If you see, the last 10 years has been very good for affordable housing, and the penetration is still low. It could continue to grow at high rates, but like I said, if you go down the curve, let's say bank lends at 12%, it's a relatively safer bank. But if a bank is, or an NBFC is lending at 18%, by default it is a high risk segment. So it's a high risk, high reward kind of setup for investment there. I think I've answered all the questions. If you do have any more, please drop it. I'll give it a few minutes before closing it. Bank undervalued PE is, so PE you can use only uh, when the earnings are stable, or you if it's depressed. If the earnings are depressed, then you'll have to normalize the P earnings and then use a PE. There's no undervalued PE or fairly valued PE or overvalued PE, because that depends on the context which bank we're talking about. For example, today some banks are trading at, say, 12x, 13x PE. That is fair value PE according to me, because that's their ROE structure, which is difficult to be changed. It'll take time, even if they want. Is the PSU bank basket overvalued currently? So the re-rating has done, because they were very undervalued in 2020, 2021. That re-rating is done. Now I think we feel that you will get the book value compounding. You will not get any re-rating growth, because the multiples are back to peak multiples for these PSUs. So whatever the ROE is, you'll be able to get that kind of growth. Digital is growing. Will it help the bank branch? Will add profit? HDFC Bank planning to expand the network. So the reasoning given by HDFC Bank to expand the branches is that there isn't penetration in those areas, in semi-urban and rural areas. That's where HDFC Bank has been adding branches. There was a study by a recent broker that 50% of the pin codes, or 40% of the pin codes where HDFC Bank has put a branch, no other large private bank has a branch there, which means uh, so there's no presence of banks there. That's why they're putting up branches. But yeah, digital should aid growth going forward. If you see, currently the CASA ratios are coming off for banks, because people are easily able to switch from savings account to your FD account. Do you see risk in banks as interest rate increase? Say US bank failed, investment made in bonds or fixed rate deposit. So we'll have to appreciate RBI for the regulations that they have. That the situation that happened with some of the banks in US because of the interest rate increase will not happen with Indian banks, because of the structure. They can't invest more than 25% of their investments in these assets, because they anyway have their loan book growing. Not just that, within that itself, there are some categories where this is very detailed conversation that we can have maybe one-on-one. I've even made a thread on it. We can refer to it. If I have to explain, it will take a long time. Just that what happened in US banks can't happen in India, because of the regulations that RBI and the discipline followed by Indian banks. What could happen as an outcome of what we saw in US is that the runoff rate. Runoff rate is the rate at which all the depositors in a bank pull their money out and switch it out or take cash. That's called the runoff rate. Ideally, for a retail depositor like you and me, RBI assumes a runoff rate of 5%. Okay. But in one single day, we saw, I think it was SVB Bank in US, where almost 50% or close to 50% of the deposits were withdrawn in one day. So the concept of runoff rate has completely changed from global financial crisis to post-COVID crisis. So RBI will have to relook at these run-off rate assumptions that they have, because today, if all investors decide to withdraw money from a bank, they can do it just like that in 2 minutes, because it's all completely digital now. You have your net banking, internet banking, even mobile banking, so you can withdraw your money and any day. So the runoff rates will have to be redesigned by RBI. Whether ROE is a sub-measure of ROA. Yes, in a way, you could say that ROA is the ultimate profitability of the bank. Okay, ROE is a input driven measure where the bank gets to decide what kind of leverage they want to have, what kind of capital they want to have, and so on. I think we're done with the questions. I'd like to thank you all for joining us today. Tarun, can we close the webinar?
Yes, sir, we can do that, sir. Thank you all. Thank you for joining us today. Have a great weekend. Thank you,
Thank you,
sir.
everyone. Thank you, Tarun. Bye bye.